So welcome everyone. Thank you for joining us for today's webinar. My name is David Minot, and I'm the Executive Director at Mental Health News Education, the nonprofit organization that publishes autism spectrum news and behavioral health news. If you're unfamiliar with us, please check us out at autismspectrumnews.org and behavioralhealthnews.org, where you will find over 1,000 articles on each site for you to view and share. Today, we are presenting actions for organizations to take in the COVID-19 environment, presented by Josh Lamberg, who is the CEO and founder of Lam Insurance Services, the nation's largest insurance broker dedicated exclusively to social service organizations. Just a little housekeeping before we get started. Everyone will be in listen-only mode. The presentation will be about 30 to 45 minutes, with 15 minutes for questions and answers afterwards. If you have any questions during the presentation, you can type them in by clicking on the Q&A icon located at the bottom of your screen. Now, without further ado, I would like to introduce Josh Lamberg.
David, thank you very much. And thank you to Mental Health News and Education Organization. We're really very pleased that you've allowed us to partner with you and share the information we're going to today. So thank you for the opportunity. All right, actions to take in the COVID-19 environment. My name is Josh Lamberg. I'm the CEO of Lam Insurance Services. We're going to talk about a little bit about how COVID has infected the insurance market, and we're going to talk about specific action items that you could implement in your organization to help make your organization safer and as financially protected as possible. Let's see. Okay. Lam Insurance Services is the largest broker in the country dedicated exclusively to nonprofit and social service organizations. In the top 100 privately held firms in the US, we were ranked number 97. We've got over 250 million in gross written premiums with 1,500 clients across 37 states. All those clients are exclusively nonprofit and social service organizations. We've been on the Inc. 5000 fastest growing companies for 3 years in a row. One of our core values are work ethic, caring, passion, humility, and effectivity. And part of that caring is volunteering, hours within the community, which of course has been more of a challenge over the last year, and putting our money where our mouth is, so to speak, and partnering by contributing to both clients and non-clients. And you can see in the bottom left-hand corner, from 2017 to 19, we contributed more than 2.6 million back into our nonprofit community and partners. We had a net promoter score, despite how this is showing up and down, net promoter score of 75. That ranks up there with Apple and companies like Subaru. Because there are no companies in those privately held brokers in the top 100, those would be larger than us, that are dedicated exclusively to nonprofit organizations. We're happy to call ourselves the largest insurance broker dedicated exclusively to this nonprofit and social service space. So that's our perspective here. That's where we invest heavily in technology. We use the technology and the data we have from our clients to compile information that we'll share with you today. I want to start by first talking about, many of you have heard of a hard market, and we are in this hard market right now. So I know we have some other insurance professionals on our call with us today, but this is probably an education for some of you that are not in the insurance industry. And I'm going to start with where we were 18 to 24 months ago. And what we would have said was, what I would have said and did say a year and a half, 2 years ago, was for every dollar of claims, an insurance company wants at least $2 of premium. And that's the fundamental premise of insurance, way oversimplified. So why does that dollar in claims for $2 of premium, why do insurance companies want that? Well, if we look here in the middle, that's a $1 claims for $2 of premium is a 50% ratio. And if we break that down to how insurance companies spend their money, ideally, for every dollar they pay out 50 cents in claims, their overhead, the cost of their insurance, underwriters, paying rent and electricity. Their overhead is 35%. When you take that 35 and 50, that's 85%. That's called a combined ratio, and there's 15 cents left for profit. And that ideally is how the insurance company model works. However, before COVID hit us, we started seeing two things come into effect. The biggest of which was the insurance industry is calling it social inflation. So you may or may not have heard that term. What does social inflation mean? Social inflation means that over the past 24 or 36 months, the industry has seen a significant rise in the dollar amount that claims get paid out for. So historically, if it was a slip and fall and it would have been a $20,000 or $30,000 payout, those slip and falls are now starting to get paid out at $50,000 or $100,000. And even more so on larger catastrophic claims, where claims would be settled for $1 million and $2 million. Many of us have seen in the media, you can see it on the news, some of these claims now are getting paid out for $25 and $50 million. So the rise in social inflation and the opening up of the Child Victims Act for some old historical unaccounted for abuse claims started to increase the ratio of claims to premium collected. So this was early in 19, we started to see a breakdown in this insurance model. Our overhead remained at 35%, give or take for most companies, but claims started to creep up. Now, so the reality has changed even further since then. So we had, now this really kicked in the fourth quarter of 2019. That's when the hard market started. And then COVID kind of really increased the rate of insurance company losses. So what we're seeing is insurance carriers' reinsurance their reinsurance rates have gone up. So first, let's notice overhead was at 35%. And this is across the industry, we've seen carriers' overhead increase nearly 20%. And a lot of that's due to their reinsurance costs. Now, why is reinsurance going up? Reinsurance is going up because you had some major COVID claims that came from tremendous corporations like the Disneys or the airlines or further the cruise ships. They had business income losses that got sent to reinsurers. Reinsurers then started charging more across the industry. That created an increase in overhead. Then in the actual claim payouts, we saw some COVID claims being paid. We saw more Child Victims Act claims. We saw large catastrophic property losses with wildfires, with floods, and we have this tremendous increase in claims. So when we get to this 135% combined ratio, which is where we see claims at 94 and overhead at 41, and carriers are collecting $1, but paying out $1.35 in claims, we see a reaction from the insurance industry. So what do they need to do? What cost $1 before, all of a sudden they need to charge $1.50 for to try to regain the same 15% profit. And once you do that, where we were charging $1 of claims is $2 a premium, that now becomes $1 of claims is $3 a premium. Or underwriting loss ratios were at targeting 50%, they're now targeting 33%. So this is, as best as I can, the hard market explained, how the financial, and this is really an education on how the financial model of the insurance carriers work to affect their pricing. And that's why what you're seeing from many of your insurance carriers is increased costs. With this, we also see a diminished capacity. So where previously carriers had 10, 15, 20, 25 million in abuse and molestation or general liability and excess liability limits available, those limits of insurance are now dramatically diminished. And carriers, many times they're going and offering 5 million. Some carriers can offer 10 million in these limits, but the capacity, the insurer's availability to offer this has gone down significantly. All right, so that's the hard market, which is part of understanding that is part of understanding how you can handle best your insurance in this COVID environment. we wanted to share some more perspective on who's being affected. So on the left side here, we have nonprofit organizations by our tiering structure. So small nonprofits we generally see with budgets less than 5 million. Those are budgets less than 5 million. So premiums under $50,000. Those tend to have very few losses, and they're seeing fairly minimal increases. That next tier is 5 to 10 million. So you're talking about accounts that are paying $50,000 to $100,000 in their property and liability. Seeing still fairly profitable accounts, but we're seeing more increases. This tier 2 accounts are 100 to 500,000. Those accounts tend to have more vehicles, own more property, have more care, custody, and control. We're seeing, on average, this is through 2020, a greater than 10%, 11% premium increase. So these premium increases account for changes in exposure. So if a nonprofit was paying $100, they pulled some vehicles off the road, their renewal still wound up being at $111. That was on average in 2020. Finally, the largest tier, clients paying over $500,000, are seeing the greatest increases. We attribute this fact to over the past decade, we've had one carrier kind of dominate the space of these large nonprofits, and they've defended that space pretty fiercely. And in doing so, there's been fierce competition for the largest nonprofits, which has driven down price in the accounts that were spending the most money. Now, as we see ourselves in this hard market and in the COVID environment, underwriters are really across the board finding discipline to underwrite to that 33% loss ratio. So we're seeing a lot of truing up of premiums in this large space. And these nonprofits are not necessarily paying more rate than everyone else, but there's larger premiums because where they historically had depressed rates, they're finding that they have to get to the same rate everyone else is paying. So that's by size how we're seeing premiums affected. On the right-hand side of this model, we broke down exposures or functional services. And you can see the more care, custody, and control of the consumer, the more residential services, really very much tied to the size of the organizations as well. That's the largest increases we've seen. So anything with habitational or residential exposure, we've seen really dramatic increases. And that goes along with a very diminished capacity or appetite for insurers to insure there. Medical malpractice, medical offices, really big increase. You can see kind of as you move to the right on this model, the less kind of touch, the less care, custody, and control, the smaller the increases. So this is how things look across our book of business and how we see it in the industry right now. We did some 5-year trend analysis that we wanted to share. So we went back, the hard market has really been here for a bit over a year, and we looked at auto rates over the last 5 years. So you can see we've had a 37%, almost 40% increase in auto rates. Property, nearly the same, a 40% increase in what rates are being charged to insure property values. The largest differentiator right here over the last 5 years, almost 100% increase in the total cost of excess liability and a 50% increase in liability rates. So this market has gotten harder. Rates have gone up significantly. We don't see this ending. Probably the end of this year, even into 2023 is what, into 22 is what many of our carriers are telling us. Their reinsurance costs are going up dramatically this year. And although we've seen some smaller claim counts due to COVID, there's many latent claim issues, and we're going to talk about what you can do to protect yourself there. But this hard market we expect to continue for another 12, potentially even 24 months. The last thing we wanted to do as far as rates, we wanted to drill down, because this market is so hard in excess liability limits, we wanted to share perspective on this. So the smaller accounts, smaller nonprofits that are buying smaller limits, we're seeing the lowest increases. So on the left, we were able to benchmark all of our accounts that have less than 5 million in limits. And you can see from 2,400 per million up to 2,800 a million over the last 3 years. From 5 to 10, these are insureds that purchased between 5 million and 10 million in excess liability. So you can see a much bigger bump here, almost 100% bump over the last 3 years from 4,000 or 50% bump from 4,000 to 6,000. And where it's largest is in this 10 million plus, and you see more than a 50% increase from 9,000 to 15. So that's closer to a 70% increase there. But the excess liability, your ability to buy umbrella insurance, any buyer, the limits are, there's less limits available and the cost per million to buy has gone up significantly. All right, that's what's going on in the market. That's what you're going to face as far as pricing goes as your renewal comes during this difficult financial environment during COVID. Now, what can you do to help protect your organization? So there's 3 things that we've identified. We're going to create documentation, you're going to submit claims to reserve your rights, and request credits on your insurance policies. Those are the 3 kind of core fundamental actions that you can take to help protect your organization. So when you create documentation, what do we mean and how do we do it? And this presentation will be available upon request. You can email David. When we're done, you'll have our contact information at LAM. So don't feel like you have to take notes. If you're looking for any of this information, we'll be happy to share it with you. So what do we mean create documentation? First, how do you do it? Our acronym is IDAR, item, date, amount, and relationship to pandemic. So anytime you have an additional financial expense or a financial loss, we want you to capture what the item is that you are paying additional for, or what the what the loss of income was, when it occurred, how much was it, and how was it related to the pandemic. So we're not seeing right now any government fund. We've seen the PPP come out and make many of the nonprofits, I'll stop short of saying make them whole, but help support them. Business interruption insurance that many thought might indemnify insureds for their business income losses is not being triggered, because nearly as a rule, all insurers include a communicable disease exclusion on their property policies, and which negates the business income losses. We're still recommending that our insureds collect this information in case at a later date there's government or insurance company law that comes out. This will help you recapture any of the losses should they become available. Now, number 2 here is probably a more critical issue, or at least just as critical. Document the precautions you've implemented. So over the past year, we've seen generally a 20% reduction in claims during the COVID time period. So we have 20% less auto losses, 20% less liability claims, et cetera. Right? Auto is a great example. Less people are driving their cars, so there's less activity and you have less accidents. So with that said, the latent claims that will come in, and generally the statute of limitations is 3 years. So anybody has 3 years to make a claim because their property was damaged or they were injured due to the way your organization may have handled COVID. All right, so with that said, what's important is that you're documenting right now the precautions you've implemented. If the CDC comes out and says you have to have your employees that are working in group homes tested twice a week, it's excellent, and we have to follow the CDC guidelines. So of course they should get COVID tests twice a week. But nearly as important, in order to protect yourself and your organization, is documenting that you've implemented these precautions. Because when the claims come, 18 and 24 months from now, saying yes, we did it is going to be great. But it won't help you protect yourselves in a court of law as much as capturing a log and having one or two executives sign off that we implemented these procedures on this date. Proving that you implemented them will be the facts that protect your organization when the likely scenario that unfortunately we will have claims that hit us due to COVID. So document the precautions you've implemented. All right, now we're going to talk about submitting claims. We're going to submit business income losses and when there's a potential for third-party liability suits. So I've said already that it's likely the business income losses will be denied. And we believe, we did see recently one court in London overturn a business income loss. We haven't seen that hit the US statutes yet. Right now, business income losses due to COVID are being excluded. Nevertheless, as you document using our acronym IDAR, all of your losses, submitting them to your insurance carrier in case any of this legislation is turned over is the right thing to do to protect your organization. Now, when there is potential for third-party liability suits, if you're an organization that has care, custody, and control of other individuals, and anybody has gotten sick, is it possible that a suit could be brought against your organization? Overwhelmingly, the chances are yes, it is possible if you're taking anybody in your care, custody, and control. So most liability policies, starting back at the beginning of 2020, the liability portion of policies did not have COVID exclusions on them. As a rule, nearly every single carrier includes them now going forward. So by submitting a claim to the carrier that was in effect during COVID, okay, by submitting a claim and saying, I'm aware of a situation that could give rise to a claim, allows you to reserve your rights in case claims do come up at a later date. Carriers, it's possible they could deny claims because you were aware of a situation and failed to let them know about it. So submitting these claims now is an important action to take to reserve your rights as an organization. Now, requesting credits. Insurance is governed at the state level, and different states have come out with different edicts on how premiums could or should be returned. But auto credits are something that, from a state like New York, which has said carriers need to give some credit, but haven't given specific direction, to a state like California, which has said it has to be 15%. Auto credits can be retained. Workers' compensation payroll mods, getting credits on your workers' comp payroll are both important actions to take. And before we're done, we're going to talk about cyber liability. We're going to talk about risk management that you can do to protect yourself there. First, I want to give you an example of how you can request credits on your auto fleet. So what we did at Lamb for our clients, and we're suggesting that each of you do, you can see in our example, we had a fleet of 8. 3 of the vehicles came off from March to May. Now, because those vehicles were not being used during that time period, you can request a credit from your insurer. Now, there's no law that says what kind of credit that they have to give. In some states, credits haven't been mandated. However, the way we suggested our clients handle this is to take a simple spreadsheet, as you can see here, list all the vehicles by VIN number, and then identify which vehicles have been taken off the road for what time period. If you provide your insurer through your insurance broker with specific data like this and say, I would like a credit for this time period, many insurers are reacting positively to that and giving credits for the time period vehicles weren't used. But providing them documentation about which vehicles were and were not used for what time periods, that's a key fact to holding the insurer accountable to giving you credits. If you just say we want credits and don't provide them with the fact that vehicles weren't used or were off the road or license plates were turned in, any of the above, the insurance carrier is much less likely to give you credit. Okay, workers' compensation. Now, workers' compensation policies are audited. What's an audit? An audit means at the end of the policy period, 2 months after the fact, the carrier is going to ask you for your payroll information. As you provide that, they will adjust the premium you paid because your premium was based on an estimated payroll. So some insurers were willing to offer credits in the middle of their policy period. Some insurers are going to collect these credits at audit. So the way we've created some online tools for our clients, the way we're going to recommend that any of you request these credits is something that looks like this, creating a list of your class codes and what location they may be listed at, a description. This is fairly technical work, and you may need to ask your insurance broker to help you with this. A list of your class codes with job description, your pre-COVID annualized payroll, and then put in, this would be after the policy period upon audit, put in what the actual payroll was. As you see here, payrolls go down, right? You will get credit for that. In addition, different states have created the opportunity to report payroll for telecommuting employees. So if I was running a school and I had teachers that were coming into my school every day, they would be charged at a certain rate. If during COVID, my teachers were 100% telecommuting, the teacher rate is generally $2 for every $100 of payroll. The telecommuting rate is about 20 cents for every $100 of payroll. So reporting the information upon audit to your insurance carrier in this detailed manner, providing the insurer with facts, will help you reduce your premiums and get you credits on your workers' compensation payroll audit. Okay, cyber liability. Now, a few years ago, 4 or 5 years ago, as we were out talking about cyber liability and we were getting questions about it, my honest reaction at that time was, I haven't seen any cyber claims, and I don't know if it's the right purchase. My perspective has changed as the world has changed, as the facts in front of me have changed. I tell everybody on this call, this is a 100% necessity, and it should be a mandated coverage. So cyber liability can protect you in many different cases. They can protect you from ransom attacks. It can protect you from leaks of information. It can protect your organization when personal identifiable information is stolen. So we have a little example here, but I'll tell you that over the last year, we had no less than a half a dozen claims that were cyber-related claims. So cyber ransom claims. So what's a cyber ransom claim? That means that a hacker infiltrated somebody's system, and what they did was capture the information that was on their server, and they password protected somebody's individual server, and they would not release the information until a ransom was paid. This happened. It happened no less than 6 times where we had clients with cyber liability policies in place, and the ransom was greater than $100,000 that was necessary to be paid in order to get the information back. So these cyber policies, these cyber hackers are specifically attacking our nonprofit and social service space. I think they've identified that information is still stored on local servers many times. The resources and funding it takes to lift everything we have up into a cloud can be very expensive. And these cyber ransom attacks are really rampant. I'd be surprised if everybody on this call hasn't seen a phishing attempt or some type of cyber hack in their email system. So with that being said, there is something you can do immediately. There's something that you can do immediately to help protect yourself from phishing attempts. So what's a phishing attempt? This is another type of cyber attack. That phishing attempt is when you as an executive might get an email from the finance department to approve a wire transfer of X amount. And we've been attacked like this at LAM. My CFO gets an email that appears to be from me saying, please wire $50,000 to X bank account. Now, when there's a bunch of ways to spot this. It may say Josh. We've had people, our CFO's named Dan. He in the email they'll refer to him as Daniel. That's not a name that I commonly use. Checking the exact email address, making sure we've seen jlamberg@lamis.org or .uk as opposed to .com. That the suffix is another way to check. But there's one simple thing that you can do to help protect your organization. We've implemented a couple years ago: dual authentication. So before my CFO or anybody in our finance department makes a wire, they have to get a phone call or text message from the person requesting the wire to validate that it's not a hack. It's something easy that you could do in your organization later today. Say from now on, nobody makes a wire, nobody responds to an email request without getting a phone call and speaking to your coworker live or getting a text message. We've yet to see one of these phishing attempts be able to hack the phone and the email at the same time. So easy loss control that you can implement. So that's what you can do to protect yourself. As your renewal is coming up, what can you do to help protect yourself? So losses, as we started this discussion out, losses are what drives costs. So what can you do to help yourself in your insurance renewal? So ultimately, each renewal is based on an underwriter's decision. So understanding where your losses are as an organization is important. So you want to review your organization's largest loss drivers and identify mitigation factors. So that's insurance speak for saying if you have a lot of auto claims, you want to do something to mitigate auto claims. If it's slip and falls, what are you doing to stop slip and falls? And again, documenting the effort, documenting the risk management and loss control that your organization has in place to make sure that you can show the underwriter you are a better organization to take risk with than your peer, right? You're one that an underwriter would want to go out on a limb and give a little more aggressive pricing to, because you have such great loss control in place. So you want to start early. You want to enable your broker to advocate for you early. So clean up any supplemental applications, updated any information. Do your best to get that together early. Put together any and all documentation about the risk management you have in place. Again, it's one thing to do it. It's another thing to be able to document what you've done, because insurance companies like facts. And when an underwriter has a fact sheet about what loss controls in place in their file, they're much more likely to take some personal risk and offer a credit or offer a reduced increase for you as an organization. So we've been in a very quick manner around the world in about 30 minutes. Hopefully you understand now what is causing this hard market, what's causing prices to go up, how much prices have gone up over the last 3 to 5 years, what you can do to make your organization safe and protected during COVID, and finally, what you can do to advocate for yourself, help your broker make sure your renewal goes as smoothly as possible. So I want to thank everybody for their time and attention.
Thank you, Josh. We will go ahead and take some time for questions now. Just a reminder, please be sure to type in your question by clicking on the Q&A icon located at the bottom of your screen. We do have some questions. The first one is from Robert. How are you dealing with increases in D&O?
Great question, Robert. D&O, so that was not a specific line item that we reviewed today, and we didn't benchmark those increases. And really, we didn't do it because those tend to be smaller premiums compared to the package, but that is a very hard market. So we're fortunate at LAM because we specialize. There's about 30,000 insurance brokers across the U.S. and probably 29,500 of them are generalists. and they handle all forms of insurance. When you're a generalist, you need more. Insurance carriers have different appetites. So CNA likes Main Street business. They like restaurants and butcher and baker and candlestick maker. That's most of the marketplace. At Lamb, we've been really disciplined and we've focused in just our unique space, nonprofit and social service organizations. Because we've had this unique focus, we actually have many carriers. We work with almost 30 different carriers that have an appetite for this. So ultimately, what we're doing to offset it is, bidding out insurance renewals. But certainly within the D&O space, we're seeing deductibles go up and we are seeing rates go up. Thanks, David.
Next is from Peter. Does submitting a claim that is likely to be declined going to negatively impact my premium in any way?
So that's a common fear. And this answer is kind of short but sweet. No, you submitting a claim due to COVID is not anybody, I think, anybody that tells you you're going to have a bad renewal just on that basis, I think that's faux. Submitting a claim on something like the COVID business income losses is not going to negatively affect you.
This is another question. Given the suggestion to alert carriers to potential claims when there could be a claim later, should a nonprofit that provides residential services to people with serious mental illness alert the carrier every time there was a COVID death among those being housed?
Yeah, that's a great question. So carriers have the right to deny claims based on late reporting. So if you're aware of a circumstance that could give rise to a claim and you don't give the carrier the opportunity to defend itself, they can deny a claim. So I've had clients ask me, Josh, should we submit a claim every time anything happens? Our suggestion right now, if you have something significant like a death, yes, that is a specific circumstance you should make the carrier aware of, certainly. And if you haven't had something that significant, making a general statement like, we're aware COVID was present in our facilities and it may have led to claims, you can start by making a general statement. But if there is a specific death and there's reason to believe they could sue you, absolutely, that's the time to make a claim. Make a notice of a circumstance. I want to correct myself. You're not making a claim, but you're calling the insurer or your insurance representative and saying, I want to make the carrier aware of a circumstance that could give rise to a claim.
Great. Given the hard market, is there any advantage to group purchasing as a way to control premium costs?
So yeah, purchasing in bulk generally is an effective way to offset premium increases. It can be very, very challenging. And it depends by line of insurance. For workers' compensation is tied to specific EIN numbers, federal employer identification numbers for every organization. On the liability side, and we've been involved in group purchasing before, and there are a few times we've done it successfully. Unfortunately, when you have a heterogeneous mixture of organizations, when you have a bunch of organizations that perform differently, this account has poor loss control and they play bumper cars, there's a lot of auto claims. This account only has 2 vehicles, they're very conservative, they have no claims. The challenge with group purchasing is inevitably the accounts that have fewer claims wind up paying a little bit more, and the accounts that have more claims wind up paying a little bit less. You have the good offset the bad. And that is, in insurance, we call that the law of large numbers. We can take an average and estimate how many claims they're going to be so we know how much premium they're going to have. So if you have a large group that all performs in a similar manner, that is typically a way that everybody can benefit. Other group purchasing efforts will inevitably offset some of the best performers with the worst. You're going to wind up with more of a medium rate to be applied to everybody. So group purchasing can be a challenge.
This question is from Joe. Why would we want to reserve our rights on a claim we know will be denied?
So, a good question, Joe. I think that the claims will be denied for business interruption. I think it is good practice and good diligence for your organization. In the insurance is a contract. Our contracts are regulated by our laws. Laws get overturned, laws get changed. There's case study that changed the situation. And if those denials were overturned for some reason, and frankly, I don't see one right now, but if they were overturned, I was the chairman of a board of a nonprofit, I would want my organization to have their ticket in line, so to speak, first, before carriers went bankrupt, before any kind of mayhem may occur. So it's really just good due diligence and I think a good housekeeping practice.
A question from Claire. What form of proof do we need to submit to show when our employees started working from home and stopped using specific vehicles?
So Claire, I have not seen like an industry accepted form. This is generally what we've seen is just being honorable. So you document, you put it in a spreadsheet, send it, have an executive director send it, or an officer of the company send it on an email, and that's your testing to those being the facts. But I haven't seen in the industry any specific accepted forms. Good question.
And there's still a few more. Question from Jen. Is a fundraising loss considered business income?
That's so we've gotten that one repeatedly. I have a fundraiser every year, and this year I couldn't have it because of COVID, so we didn't raise the $1 million that we raise every other year. These type of losses are going to fall under the same communicable disease exclusion, right? And frankly, I doubt they're going to get paid for. You have to, in any of these losses, you have to prove the loss. So ultimately, I think the fundraising losses, this whole thing is a bit of a Hail Mary. Fundraising is a Hail Mary on top of another Hail Mary. I really don't think they would be, I don't think they would be paid. But if you're taking the time and effort to do the proper due diligence and submit this, I don't see anything wrong with including it.
We have a question from Sal. If a home care worker contracted COVID-19 working in a home where a family member of the client was diagnosed positive for COVID, should we file a claim?
So workers' compensation, contracting COVID as a form of workers' compensation is different. The way your insurance policy reacts is different from state to state. So in New Jersey, for an example, we have something called a presumption of liability. Anybody that contracts COVID that is working, it's presumed they got it at work, and those expenses the workers' comp insurance carrier should be paying for. So should you submit a claim? If you're aware of it, if you're aware of a worker that was injured or became ill on the job from on-the-job exposure, like you're describing here, yes, the proper thing to do is submit a claim.
Two more. Did a reduction in vehicle usage count toward premium credit, or did the vehicle need to be totally out of use?
So this one, again, is on a case-by-case and carrier-by-carrier basis. What we're seeing here is that if you used it less, my vehicle was in continual use throughout the year, but I used to drive it 5 days a week, and now I only drove it one. We have not seen, but we drove it 1 day a week all year. I haven't seen carriers react and give credits to that. I think that answers the question.
And finally, it's more of a comment. Major issue for not-for-profit is auto. With telemedicine and programs being remote, auto would only be non-existent. There should not be increases. So I think that's a logical perspective. In this hard market, though, where where carriers don't understand the latent claims and their costs are rising, in that model we shared before, I think what we're seeing is claims are going up across the board.
I don't disagree with your logic. Auto claims are definitely down because there's fewer autos on the road. But long-term, auto has been the worst performing line of business. So if you look at 2019, 18, and 17, auto, the loss ratios in that line have historically been worse than any other line of coverage. So we're seeing rates go up in auto, really with an exception to the performance of that line as it occurred last year.
It looks like we've covered all of our questions. Josh, is there anything else you wanted to cover before we wrap up?
So, David, I want to thank you and the organization for allowing us to participate. You'll see my contact information is here, as well as David's. If you'd like a copy of this presentation, it'll be available. Please feel free to reach out. We'll be happy to share this documentation with you. We thank you very much. Again, I'm Josh Lamberg. I'm the CEO of Lam Insurance Services. We're the nation's largest broker dedicated exclusively to nonprofit and social service organizations. David, thank you very much.
Great, thanks, Josh. You had some great information for us today. Be on the lookout for future webinars from Mental Health News Education, featuring leaders speaking on vital topics of interest to the autism and behavioral health communities. Thanks again for joining us, and we'll see you next time.
Thanks, David.